Hi, I'm Kathy Healy with Healy Wealth Management. Today I'm joined by Bill Neglia of Neglia Insurance Group to talk about the latest and greatest in health insurance. I've known Bill for over 10 years and he's navigated all the changes in our healthcare system and continues to help clients sort through what's new and how to make the best decisions for themselves and their families. Bill, would you tell us a little about yourself and your business?
Yeah, sure. Thanks, Kathy. I appreciate the invitation to be on this platform. So I started my agency back in 1983. It was mostly a life insurance based organization. I worked with companies like Mass Mutual, Northwestern Mutual, John Hancock. That's how I got my indoctrination into the insurance world. And then in 1991, I moved my family from New York to Georgia. And soon thereafter, I decided to change my emphasis into more of a general benefits business, with health insurance being my lead product. I found it was a lot easier to talk to people, especially self-employed individuals, which was my target market, about health insurance than it was life insurance. So for the last 30 plus years, I've been running a primarily health insurance oriented book of business. I do all the other things as well, but health insurance has been my bread and butter for, like I said, for the past 30 years. I've got my son and son-in-law working with me on a part-time basis. We have one assistant, thank God, who does a lot of the grunt work and the quoting that the tedious stuff that takes me out of the field and allows me, or keeps me in the field and allows me to be more fluid and conversational with my clients, because they really need to talk to me about their options, and then my assistant can just run the numbers.
So when I'm doing financial planning for clients, a big thing that often comes up, a scenario they want to run, is early retirement. But when people are younger than 65, can't go on Medicare yet, and they're going to have a period of years when they're not covered under their employer's plan, what can they do?
Yeah, so they're outside of an employer group plan, which historically is the best option for people if it's available to them. For the last 15 years, the marketplace has been, where a majority of people have gone, especially those that have pre-existing conditions or incomes that allow them to qualify for tax credits. The thing is, going forward, in 2026, people are going to be in for a real rude awakening, because not only are the gross premiums going up across the board with all the carriers, the tax credits, which were enhanced under the American Rescue Act in 2022, those are going to expire December 31st. And as of right now, they're not going to be renewed. And that's the main reason why the government still is shut down and they haven't agreed on a budget. The Democrats want that reinstated, and the Republicans are saying no, they were set to expire and we're going to let them expire. So that's the problem, and of course in the crosshairs are the consumers. And people, especially the last 4 years since the enhanced credits went out, have been leaning on those credits to pay for their health insurance. Open enrollment started on Saturday, and the rates and plans just came out. And in the small sample size that I've looked at, and the people that have called and emailed and texted me who have gotten their renewal notices, we're seeing increases of 100, 200, 300%. Because a lot of people, they've now fallen out of that threshold that the extension put them in, so they no longer qualify for the credit. So their credit last year may have been $2,000 a month, and that's gone. Plus the premium, which, let's say was $2,500, is now $3,500. So it's not unusual for somebody who maybe paid a net $1,000 a month last year to now be looking at $3,500 a month for the same plan with a higher out-of-pocket maximum. So that's the sticker shock that people are now being exposed to. And I think my guess is about 75% of the marketplace population from 2025, I don't think they're going to be able to stay in the marketplace in 2026. I think even the cheapest option without a tax credit is probably going to be more than they're going to be willing or wanting or able to spend. So I think I'm afraid that market may just totally crash in 2026. And what'll happen going forward, who knows, but if 75% of the marketplace leaves and all you have left are either the very unhealthy or the very economically challenged in that market, you have a poor risk pool, which means it's only going to get worse going forward. So we could be seeing ultimately the end of Obamacare in the next year or two, if things continue the way they're set up right now.
So even before November 1st, I think you told me that a few carriers had pulled out.
Well, Aetna, yeah. So from 2025, spring, summer of this year, Aetna announced that they were pulling out of the marketplace in all states, not just Georgia. So they're just basically focusing on group insurance. So anyone who has an Aetna marketplace plan has to change to another carrier, regardless of their circumstances. And you got situations there. I just literally, while I was waiting to come in here, I had a client call me, and his wife is due to have a baby in January. And they're with Aetna. And now they have to change to another carrier, and there's no guarantee that the OB who's been treating her these 8 months prior will be in any of those networks. So that's going to make their situation really challenging. And that's the other thing, as the marketplace has, in my opinion at least, eroded over time, the provider network has also eroded. So a lot of doctors and hospitals that were in the marketplace years ago, slowly but surely have been pulling out. Okay, they're either going into concierge practice or joining larger practices or combining practices or getting out of medicine altogether. So we're seeing a perfect storm of bad events going on as it relates to the ACA Affordable Care Act marketplace. And I think 2026 is going to be the worst year since its inception. And the problem in 2014 when it started was just, it was an unknown and the website had a lot of problems. But once they kind of solved the website issues, things started moving pretty fluidly. But I think 2026 is just going to be, it's going to be tough. It's going to be tough not only on consumers, on agents, trying to, balance, okay, your premium went from this to this. The options aren't much better. We can look at alternatives, but if you're sick or you barely make enough to feed your family, I think we're going to have a big uninsured market or population in 2026, probably as big as prior to Obamacare starting, when people just decided, hey, I'm just not going to go without. So yeah, it's a challenging time right now for health insurance, especially private insurance.
So tell me how you help people and the value of using somebody like you, a broker, or somebody that can help guide consumers.
Well, sure. Well, the first thing is, again, I've got 40 plus years experience, okay? And I don't charge a dime for my service. So right there's no economic reason not to do business with an experienced agent. So if you were to go do it yourself through a website, a call center, you're going to pay the same price. Only you're not going to get the advice from that operator who's not even an agent, just a clerk, taking down your data and reading off a prompter. You're not going to get the advice, and especially if you call Blue Cross, they're not going to tell you about, hey, United has a better plan, or somebody else has a better plan, or if you go on either healthcare.gov or now in Georgia, georgiaaccess.gov, yeah, you'll see different plans, but it's just going to look like, a Chinese menu. There's just so many things literally there are, for any given person or family, about 150 different plans to choose from bronze to silver to gold. Now, how is the average person going to that's just going to overwhelm the average person, as trying to find out what's the right plan for me. So when I talk to a client, my process is very simple. Whether you're a referral new client or a prospect, or you've been with me, and we come to this time of year where it's time to look at renewing or repurchasing, my process is exactly the same and has been for years. I have an intake form, questionnaire. All right, I've played with it over the years. I've cut and pasted, and I won't say it's perfect, but I think it's pretty darn good. And it asks the questions that the average agent doesn't. Just getting somebody's birth date and their address and sending them a quote is definitely not doing your job right. Because you can have what on paper looks like the best plan, but if your doctor doesn't take it, it's no good. If your prescription, especially if it's expensive, is not covered, that's no good. And basically, you don't know what the plan is going to give you just by looking at what's on the market, on the website. So we take the questionnaire, we evaluate, and again, we assume everybody is truthful. There's things we can't control. If you don't tell us the truth about your health, we can't, we're not mind readers. But if everybody's truthful about their health, their meds, and to some degree what they think their income's going to be, then we can create through a software tool that we use, create quotes, send them to the client, and then the client can at least look at some of them, and then we can have a conversation and then go over specifics. Hey, yeah, this plan from Kaiser looks good, but Kaiser doesn't allow you to use your own doctor. Is that important to you? Yes, no. Well, that if it was a flow chart, that would dictate where we go with the conversation. Some people love Kaiser. They love the convenience of going to a center and having all of their medical care covered, other than being hospitalized. And then others hate it. So Kaiser is one of those, 50-50. But, as far as all the other plans where you can pick your private doctor from, private practices, it's important to know if your doctor's in the network, if they're leaving the network. See, the thing is, the internet gives you a snapshot of today. So I might run a quote for you today, and it says your doctor takes the plan. Doctors, hospitals, all facilities sign contracts, and those contracts expire, and they don't all get renewed. Okay, so your doctor in November 4th might be in your network or the network you're looking at. You buy that plan based on that data. In January, you go for a visit and you find out the doctor dropped out of the network. You have no coverage because all the marketplace plans are HMOs. And HMOs only cover you in network unless you have a serious life-threatening emergency. And that emergency is defined by the insurance carrier, not you. So you might think you're having an emergency. The insurance company says, no, we don't consider that. And you went out of network, we're not going to pay. So, there's a lot of variables involved when you're buying from the marketplace because there are so many specifics that have to be identified before you can even come to a conclusion on which is the right product. And we take them from A to Z. If we have to even help them with the enrollment, we can do that over the phone. Most of our clients just hit the add to cart, like buying off Amazon, and just answer the questions. But some, want our help, and we're willing to do that. And, that's part of our job. But you won't get any of that if you deal direct with a website or carrier call center.
So somebody's leaving their job right now, and they're looking at Cobra versus ACA Marketplace, Obamacare. That's
private, anything, private insurance.
How do they make the decision?
Well, again, you want to talk to a professional first. Years ago, Cobra rates used to be so outrageous, people didn't even consider that. As time has gone on, Cobra has become much more competitive to what's available privately. And I'd say right now it's probably a 50-50 whether or not Cobra is the better option than going private. Something that you have to understand as a consumer, if you're on Cobra, if you're thinking of canceling it, let's say mid-year, and then going on a private plan, all the deductible that you've accumulated during that however many months goes away, because the private plan doesn't carry over the Cobra deductible. So you could have somebody who may have met their deductible in June, and then they go on a private plan July 1. Well, now they have a whole new deductible to meet under the new carrier. That's an important thing to decide, if you still have the ability to keep the Cobra. Now, if Cobra runs out, it runs out. There's no alternative. You have to get something private. But I have people come to me saying, hey, I'm on Cobra. It's good till, the middle of next year, but I'm thinking about switching to something, private. And my first question is, what's your health? Have you had a lot of claims? Have you met your deductible? Things like that. And if they say, yeah, we met our deductible, my wife had a baby, or we had surgery, and our deductibles met, well, that's a big variable to consider before leaving Cobra to go onto a private plan and start that deductible all over again. And then the other thing is the cost. Again, if Cobra's $1,800 a month and private insurance is $1,500 a month, is it that much of a difference? Cobra is going to be group insurance, which is always going to be your best bet. Most of the time it's a PPO. Is it worth for $300 a month going to an HMO plan that's not going to have the same level of coverage and require you to start a new deductible? So I would say in the last 5-6 years, I've probably talked more people out of leaving Cobra early than jumping out of Cobra, because it's in their best interest to run the Cobra as long as they can.
So let's talk about the dates. So November 1st was open enrollment.
Day one.
And what does that mean? How long does it last? When does the coverage start?
So again, this is another up in the air legislation that'll be fought over next year. But as of right now, for policy year 2026, you have one open enrollment from November 1 to December 15, and that's for coverage starting January 1. You have a second open enrollment December 16 to January 15. That's for coverage starting February 1. Okay? And it's been that way since the last administration took over. The new administration is saying already, starting policy year 2027, it's going to go back to the original November 1 to December 15, and that's it. I'm sure that will be an issue that's going to be fought in Congress next year, leading up to open enrollment for 2027. But for this year, there's two open enrollment periods. If they miss the first one, they can, they still have a second one. If whatever, by January 15th, if they haven't enrolled in a plan, then, and they don't have a existing one that they can renew, then the only way they can get onto the marketplace is if they have what's called a qualifying event. And that could be moving from one country to another, even within the state, because a lot of the plans are county-based. So you can be in, Fulton County and have Blue Cross, and move to Meriwether County and Blue Cross isn't in there. That's a qualifying event. You can then have the ability to change to a carrier that's in that county. Getting married, getting divorced, having a child, those are your most common qualifying events. Oh, and losing your employer job. That's probably the most common. Yeah. That's where I get most of my Cobra referrals from. Somebody who either voluntarily or involuntarily left their company. Now they're looking at Cobra, and now they're wanting to know, should I take Cobra or should I go private? And again, that's where the whole intake form and the Q&A and all that comes into play to help me help them decide which way they should go.
So how long does Cobra last?
18 months. So traditional Cobra, if it's just, you lost your job, is 18 months. In cases of death or divorce, it's 36 months. So if you're an employee and you have family coverage and you die, your family can keep it for 36 months. Or if you're an employee and you and your wife divorce, your wife can keep it for 36 months. So it depends on the circumstances of the termination or the, again, death or divorce of the family.
Okay. So if people are in this situation where they're not covered under an employer plan and they're not on Medicare, and for whatever reason they want something other than the ACA, what's out there?
Okay, so there are alternatives to the ACA for individuals. I would say if I was to rank them, I would say short-term major medical would probably be my number one alternative. Short-term has gone through multiple iterations. When it first came out, it was a 3-month policy and just really designed to be a bridge. And then the first Trump administration, he extended it to where you could buy it from 12 to 24 to 36 months. And then when the Biden administration took over, just this past June of last year, they cut it back to 4 months, kind of like what Obama did. And now that Trump's back, he's reinstated it. So as we speak, you can buy a short-term major medical policy anywhere from 12 to 24 to 36 months, okay? Now again, you can cancel at any time. You're locking the carrier in, you're not locking yourself in contractually. However, short-term policies do have pre-existing exclusions. They do have benefit limitations. They don't cover things like mental health, maternity. Again, you're not comparing apples and apples, but for people who are going to be either priced out of the marketplace or don't have, corporate insurance, it could be a cost-effective major medical plan and affordable. So I would say short-term is probably going to be the most popular of the alternatives to marketplace. Behind that, you have what's called indemnity plans, or another word for that is reimbursement. And if you know anything about AFLAC, that's how AFLAC works. With AFLAC, you basically go to your doctor, you pay them cash, and you get which the cash price in most cases is cheaper than even the negotiated insurance rate. So you pay cash to the doctor, You then file the claim, you being the insured, file the claim with the insurance company, and then based on the plan you selected and the benefit and the type of service, they will send you a check. So then you can then use that check to offset the expenses for the medical. The attraction of indemnity plans is that they have no deductibles, so they pay immediate benefits. So if you even just have to go to the doctor for a doctor visit, and you know your doctor benefit is $100 per visit, you're going to get a $100 check. You know, you're going to pay the doctor cash, and you're going to get a check for $100. If your doctor visit it was $75, you're still going to get $100. If it was $200, you're going to get $100. So your benefit is fixed. It doesn't matter what your cost was. So with indemnity plans, it behooves the consumer to shop around and try to get the lowest cost medical rates they can, because they're going to get the same benefit regardless of what they spend. And again, doctors will give you their cash price because it's not filed as an insurance policy.
So to get an indemnity plan, do you have to be in good physical?
You have to be relatively, and I'll use relatively, in good health. You can't have any recent history of heart disease or cancer or stroke or diabetes. But I mean, you could have some blood pressure, and the same goes with short term. You can have some high blood pressure as long as it's medically controlled. Cholesterol. Like a very common thing with women is thyroid. So I've got lots of lady clients that take Synthroid or generic versions of that to control their thyroid. That's okay, all right? ADD medication is okay. Understand you may not get covered for those meds or for any doctor visits related to those causes, but you can still get the insurance. And again, the people who are buying short-term or indemnity plans, they're not looking for the everyday nickel and dime coverage. They're willing to pay those out of pocket. They need something for major medical, the cancer, the stroke, the heart attack, the type 1 diabetic, the major accident. That's what they're buying those policies for. And that's what those policies are designed for, to provide catastrophic help while understanding the consumer will pay the basic day-to-day stuff, including wellness. Most short-term plans don't cover any wellness. Some indemnity plans will give you maybe $100, $200 towards a wellness, but it's not going to cover a mammogram or a colonoscopy in its entirety. So people have to be aware of that. And again, all of that has to be properly and openly explained up front, and that's what we do. Because I don't want an E&O claim. I've got 42 years experience. I carry E&O, but I've never been sued. I don't ever want to be sued, and I want to be able to sleep at night. So I never sell a policy without explaining not just the positives, but the negatives. And I tell all my clients, here's a quote, read the brochure. It'll tell you, it'll give you a lot of information about the what it does, what it doesn't do, things like that. So, when you buy it, you know exactly what you're getting, and you should know at claim time exactly what's going to be covered and what won't be.
Okay, so to summarize some of this, if somebody is looking for coverage for 2026, now's the time for them to be shopping around, looking to get it in place, because the time will run out December 15th.
For January 1.
For January 1st. Then there's a small window from December 16th to January 15th to get coverage by February 1st. But if any time else in the year, they're not going to be able to get insurance in the marketplace unless they have a qualifying event.
Right, they have to have a qualifying event, and like I said, I laid those out for you. But If they don't have a Marketplace policy, and then they get sick, that's not a qualifying event. It's too late at that point. Mm-hmm. So, if nothing else, at least get a basic Marketplace plan. And then if you have something happen, potentially you could upgrade that later on, depending on your circumstances in life. But the thing is, unless you're getting good information from a reliable source, you're not going to be able to make all of these decisions, especially now with all the changes. Because in 2025, I would say 3/4 of my agency just auto-renewed, because the differential between their 2025 rate and 2024 was so minimal. They took the path of least resistance and they were happy with their plan. They said, I'll just renew. It's not going to be that simple this year. So the amount of time needed to evaluate all of your options to make a decision to enroll is going up dramatically. So if people wait till December 10th and then say, I need to figure something out, they may not give themselves enough time to do anything, or if they do, they're going to do something in a rush, which may end up being detrimental. So yeah, we started sending questionnaires out to our clients the beginning of October. All right, and of course, we still have probably half our agency haven't responded, which is usual. They'll get around to it when they get, first there's Halloween, then there's Thanksgiving, then there's Christmas. There's, always an excuse why they couldn't get to it. And we tell them, we do our job. We get the information and we start the process early. That's all we can do. If you don't respond, we can't help you. All right? Because we can't assume, nor should we assume, that somebody's profile from last year is exactly the same this year. So we don't work off of that. Now, if we send a questionnaire out to someone and they email back and say nothing's changed, well, then we'll use last year's numbers. But we're not going to just arbitrarily assume that you're on the same meds and you make the same money and just blindly run quotes. We are not a quoting mill. We're professionals, and we only work once we have enough intake information. It's just like somebody coming to you and saying, what do you recommend? Right. Based on what? You need data. You need to know their data. Same with us. We can't just make recommendations without knowing their specific data.
And then for almost everybody, if they're already on the ACA or the Marketplace, their costs are going to go up with a 1-2 punch.
For the most part.
Because premiums are probably going up.
Gross premiums are going up with everybody.
And for a lot of people,
tax credits are going down. Yeah, now there are going to be some, there's probably going to be maybe 25% who will see little or no increase, okay? They're going to be the minority. It's the majority of people in the Marketplace, and it doesn't matter if you're in Georgia, New York, California, all the states are going to be impacted the same. This is the subsidy is a federal thing, not a state thing. So everybody's going to be impacted the same. And based on what I'm seeing, 3 out of 4 people have already said, I can't afford what they're renewing me at. Now, whether they're going to be able to afford the cheapest option, that's where my process comes in, and we send out the quotes, and all we can do is show them what's available. And if they say that's still unaffordable, if they're again, then I have to go back to the questionnaire and I look at it. And if there's nothing major on the questionnaire, I'll say, listen, I have some other options. Let's look at those and see what we can do. And, yesterday I wrote an individual who makes a lot of money and didn't want Marketplace, didn't want to spend the money. And I wrote him a short-term policy, a 3-year plan, premium is locked, and it was $1,500 for him and 2 kids. And he loved it. He said, that's exactly what I was looking for. I can pay for doctor visits, I can pay for prescriptions, I can pay for an urgent care visit here and there. I need major medical coverage in case me or either my children get very sick or in a bad accident or needs special care. I just need that kind of coverage. So, I think I'm going to lose a lot of my marketplace business, but I'm hopeful I can replace majority, if not all of it, with some of these alternative plans. One alternative I did not mention, and I do want to, there is now an option for individuals, self-employed, to get group insurance. Okay, I picked up I was introduced to a company last year, and they will allow you as an individual, self-employed, and you got to show them either a 1099 or a K1 or some type of self-employed tax records to prove you're self-employed, and they will allow you to join a group and then have access to the group, the company's group insurance. Now, the rates aren't cheap, but they're group insurance. They're PPO plans. There's multiple options, different carriers, different networks. And again, there are medical questions that they have to answer no to. So there is an underwriting element. But if they can pass the screening, they can get a PPO group plan just like you and anybody who works for a company. So that's another option that I'm going to have available, for that segment of my my book of business.
Oh, that's really good news for self-employed people.
Absolutely.
People with their own companies, small business owners. I think you have a word of caution about some of the sharing policies, the non-insurance.
So about 8 years ago, I got involved with MediShare. Okay, and this is not an indictment. This is just my experience. I got involved with MediShare through a general agency, and I wrote a couple of policies. First of all, MediShare is probably the most restrictive. It is strictly Christians only. They won't take smokers. They won't take anyone who admits to drinking, even socially. Their underwriting is very narrow. Their selectiveness, which is their right. But the problem my clients faced is that they would put in a claim, and at best case scenario, they'd have to wait 6 months to get any money back. And most people can't, by that time they're in collection now if they haven't paid their bill. So 6 months is not a realistic time frame to pay a claim. With insurance plans, if the claim is filed correctly, there's no missing codes or anything, those claims need to be paid within 30 days. Or at least an explanation of benefit has to go out showing, it was covered, but you owed the deductible, here's how it was handled. That's got to be done within 30 days if it's an insurance plan backed by insurance and backed by the Department of Insurance. A sharing plan is not at all insurance. They even use terms to differentiate themselves. They don't use deductible. They use annual responsibility. They don't use premium. They use contribution. So they intentionally have to use terms that mean the same as insurance terms, but are non-insurance related. And if you have a problem with a share plan, you can't go to the Department of Insurance for help because they're not insurance plans. And the analogy I give when people ask me about them is, it's like going to church and they pass around the plate and everybody puts a $20 bill in there, okay? And then it goes back up to the pulpit. And then the priest, the bishop, whatever denomination is running the service will say, raise your hand if you had medical bills this week. And, half the people. And then they'll take the money and then they'll divvy it up amongst the people who said they had claims. That's the sharing part. It's a good, no pun intended, but it's a good faith way of reimbursing people for claims. There's no guarantee that a claim is going to be accepted, and if it's denied, like I said, you can't go to the Department of Insurance and file an appeal. The share program said no, it's no. So, for that reason, I don't like them. Personally, I'm not protected under my E&O insurance. With a sharing program, E&O won't respond. So that makes me nervous. So, in most cases, I would definitely look at other options first, and then look at the sharing plans last. And if you see a sharing plan that you think is priced and seems good, sure, it may be better than nothing. You won't really know until you actually put in a claim, because paying for something that's not going to reimburse you, then you are better off with nothing.
So if somebody has a problem with the sharing plans, they're not covered under the Department of Insurance.
No,
so
because
talk
they're
a little
not
bit about
filed as insurance. They're, to be under the protection of the Department of Insurance, the product has to be filed as an insurance policy. Sharing plans are not filed as insurance policies. I don't know what they're filed at. They might be filed as sharing plans, and that might be a subset category, and that's what they fall under. But I know for a fact that if you have a problem as a consumer with the sharing program, you cannot go to the Department of Insurance to complain or appeal or ask for help or sue or do any of that, because they want nothing to do with it. So and as an agent, E&O won't cover you, because E&O only covers insurance-based products. So yeah, agents selling sharing programs and people buying them all have to be careful.
So that's a great word of caution. Absolutely. I really appreciate you being here today and sharing all this great information with us. It's an important time for people to make sure that they get covered. They watch for their deadlines, December 15th, to be covered by January 1st, and to trust a professional.
And again, the biggest takeaway is talk to a professional. Even if you don't like what they say, the truth, even when it hurts, you want to know the truth.
Okay. Well, thanks again, Bill.
Oh, great. Thank you.